Digital versus traditional assets, the ultimate guide, Bull and Block. Hey everyone, welcome back to Bull and Block. Today we're diving into the world of investing, but like really getting into it. You see, most people think investing is just about picking the right stock or buying some Bitcoin, but it's so much bigger than that. There's a whole universe of assets out there, and understanding the differences between them is key to building a truly diversified and profitable portfolio. We're talking stocks, bonds, real estate, crypto, the whole 9 yards. We'll break down exactly what each asset is, how it works, and the risks and rewards you need to be aware of before you invest a single dollar. Because at the end of the day, knowledge is power. So grab your notebooks, get comfy, and let's dive in. Stocks ownership and potential growth. Let's start with what's probably the most well-known asset class, stocks. Now, when you buy a stock, you're essentially buying a tiny piece of ownership in a company. Think of it like owning a tiny slice of your favorite pizza place. If that pizza place does well, your slice becomes more valuable. That's the beauty of stocks. There are two main types of stocks: common stocks and preferred stocks. Common stocks are your standard stock, giving you voting rights in the company and potentially paying out dividends, which are basically a share of the company's profits. Preferred stocks, on the other hand, work a little differently. They usually don't come with voting rights, but they offer a fixed dividend payment and have a higher claim on assets if the company goes belly up. Now, the stock market can be a bit of a roller coaster. Prices go up, prices go down. It's enough to give anyone motion sickness. But historically, stocks have delivered some of the highest returns compared to other asset classes. Remember, diversification is your friend. Don't put all your eggs in one basket, especially when it comes to something as unpredictable as the stock market. Bonds, lending, and fixed income. Now let's move on to bonds. Unlike stocks, which represent ownership, bonds are more like loans. When you buy a bond, you're essentially lending money to a government or a corporation. They promise to pay you back the principal amount. That's the original amount you lent, plus interest over a predetermined period. Now, bonds come in different flavors. You've got your government bonds, which are generally considered low risk because, well, it's the government backing them. Then there are corporate bonds, which tend to offer higher interest rates because they carry a bit more risk compared to government bonds. Bonds are generally considered less risky than stocks, but that doesn't mean they're risk-free. Interest rates, inflation, and the issuer's financial health can all impact bond prices and your returns. But here's the thing: bonds can be a great addition to any diversified portfolio. Cryptocurrencies, the wild west of digital assets. Next up, we're diving into the world of cryptocurrencies, the digital gold rush of our time. Bitcoin, the OG cryptocurrency, is often seen as a digital version of gold, a store of value in a digital world. But the crypto market is much bigger than just Bitcoin. We've got altcoins, the cool kids on the block like Ethereum and Cardano, each with its own unique technology and use cases. And then we have stable coins, which try to, well, stay stable by pegging their value to something more predictable, like the US dollar. Now, cryptocurrencies can be incredibly volatile. I mean, we're talking about price swings that would make even the most seasoned investor sweat. But this volatility also presents opportunities for massive gains. It's crucial to do your research, understand the technology, and only invest what you can afford to lose. Now let's shift gears to mutual funds, a great option for investors who want to diversify their portfolio without the hassle of picking individual stocks or bonds. Mutual funds pool money from multiple investors and invest in a diversified portfolio of assets, like stocks, bonds, or a combination of both. Think of it like a giant investment party where everyone chips in and a professional fund manager takes care of all the hard work, picking the investments, managing the portfolio, and trying to beat the market. Of course, they take a small fee for their services, but hey, that's the price of convenience, right? There are tons of mutual funds out there, each with its own investment strategy, risk profile, and fees. The key here is to find a fund that aligns with your investment goals, risk tolerance, and time horizon. Next up, we have exchange-traded funds, or ETFs, which are like the cooler, more flexible cousin of mutual funds. Similar to mutual funds, ETFs also invest in a basket of assets, but here's the key difference. ETFs trade on stock exchanges just like individual stocks. This means you can buy and sell ETFs throughout the trading day, giving you more flexibility and control over your investments. Plus, ETFs tend to have lower fees compared to traditional mutual funds, which is always a good thing. And the best part, ETFs come in a smorgasbord of flavors. You've got your stock ETFs, bond ETFs, commodity ETFs, even crypto ETFs. This allows you to target specific sectors, industries, or asset classes that you believe will outperform the market. Remember, diversification is key. Now, let's move on to commodities, which are raw materials or agricultural products that are traded on global markets. Think oil, gold, wheat, coffee, the stuff that makes the world go round. Commodities are considered tangible assets, meaning they have a physical form and intrinsic value. This makes them particularly appealing during times of economic uncertainty or high inflation, as their value tends to hold up better than paper assets like stocks or bonds. Investing in commodities can be a bit tricky. You can either buy the physical commodity itself, like storing barrels of oil in your backyard, which I wouldn't recommend, or invest in commodity futures contracts, which can be complex and risky for beginner investors. However, commodities can play a valuable role in a well-diversified portfolio. Chapter 7. Real estate, building wealth brick by brick. Let's talk about real estate, one of the oldest and most popular asset classes. Investing in real estate typically involves purchasing physical properties like residential homes, commercial buildings, or land. Real estate can be a great way to generate passive income through rental payments and potentially benefit from property appreciation over time. Plus, there's just something satisfying about owning a tangible asset like a piece of land or a building. But hey, so who says you need to buy a whole building to invest in real estate? Real estate investment trusts, or REITs, offer a way to invest in real estate without the hassle of being a landlord. Chapter 8. Now let's talk about derivatives, not the calculus kind, don't worry. Financial derivatives are contracts that derive their value from an underlying asset like a stock, bond, or commodity. Two common types of derivatives are options and futures. Options give you the right but not the obligation to buy or sell an underlying asset at a predetermined price and date. Futures, on the other hand, obligate you to buy or sell an asset at a future date and price. Derivatives are complex instruments and are best suited for experienced investors who understand the risks involved. They're often used for hedging, which is basically protecting yourself against potential losses in your portfolio, or for speculation, which is making bets on the future price movements of an asset. Chapter 9. Next, we're diving into the exciting world of currencies, also known as Forex, the largest and most liquid financial market in the world. In the Forex market, currencies are traded in pairs, with the value of one currency fluctuating against another. Think of it like a giant global flea market where you're constantly exchanging different currencies, trying to make a profit from the ever-changing exchange rates. The Forex market is influenced by a myriad of factors, including economic indicators, interest rates, geopolitical events, and even good old-fashioned market sentiment. Forex trading can be highly speculative and involves significant risk. Chapter 10. Finally, let's talk about collectibles, the assets that combine passion with investment potential. Collectibles encompass a wide range of items, from rare stamps and vintage cars to fine art and rare sneakers. Investing in collectibles can be a roller coaster ride. The value of collectibles is often subjective, influenced by factors like rarity, condition, provenance, and even current trends and tastes. While collectibles can appreciate significantly over time, they don't generate any cash flow like rental income or dividends. So there you have it, a whirlwind tour of the major asset classes out there. Remember, building a well-diversified portfolio is like creating a delicious investment smoothie. That was a lot to cover, but hopefully you now have a solid understanding of the key asset classes and how they can fit into your investment strategy. Don't forget to like this video. If you found it helpful, Subscribe to Bull and Block for more awesome investment content and hit that notification bell so you never miss an upload. Until next time, keep learning, keep investing, and keep crushing your financial goals.